I want you to take a second and imagine your absolute favorite local retail plaza.
Oh yeah, we all have one.
Right. You know the exact one. Maybe it has that independent coffee shop you visit every Tuesday morning. Or there's a dry cleaner tucked into the corner. Or perhaps a high-end specialty grocery store anchoring the whole thing.
Or if you're commuting right now, you can just picture the downtown office building you work in.
Exactly. Look at the sheer scale of the glass, the high-speed elevators, the polished granite in the lobby. Now, I want you to completely strip away the concrete and the steel in your mind.
Just erase it.
Yeah, erase it. And I want you to imagine the sheer towering mountain of paperwork required to actually buy or sell that piece of property.
It is a literal mountain.
It really is. We are talking about a stack of legal documents, covenants, and environmental assessments that could probably double as a structural support column for the building itself. Welcome to the deep dive.
Glad to be here for this one.
Today, our mission is to pull you straight into the precise, high-stakes, and frankly, kind of cutthroat world of commercial real estate agreements. We're specifically focusing on the mechanics of office and retail properties.
Which is a whole different beast.
Completely. We are going to demystify the intense legal frameworks, break down the incredibly complex clauses, and show you exactly how these massive multi-million-dollar deals actually manage to cross the finish line without, totally imploding.
And it really is a completely different universe from the residential market, which is a distinction I think we need to establish right away.
Yeah, let's start there.
If you look at residential real estate, the entire process is inherently driven by emotions.
Right.
You have families picturing their lives in a home, wondering if the backyard is big enough for a dog.
Does the kitchen get good morning light, that kind of thing?
Exactly. But commercial real estate, the emotion is stripped out completely. It is entirely about income streams.
Just raw numbers.
Just raw numbers. It's about risk mitigation, aggressive yield calculations, and an extreme, almost obsessive level of due diligence. You are not buying a cozy living room. You are buying a highly complex financial instrument that just happens to be made of bricks, mortar, and tenant leases.
That framing completely shifts how you have to look at these transactions. And the journey we have mapped out for you today is going to explore exactly how that financial instrument is constructed and protected.
We have a lot of ground to cover.
We do. We are going to explore the literal anatomy of a commercial agreement. We'll look at the rigorous, leave no stone unturned investigative phase. We're going to dig into the very specific municipal and logistical quirks of retail spaces versus office spaces.
Some fun stuff.
Oh, yeah. And then we will walk through the exact financial mechanics used to actually execute the transfer of funds. And finally, we'll look at the pre-closing nightmares that can derail absolutely everything at the 11th hour.
Those are the ones that keep agents awake at night.
Absolutely. So let's start with the anatomy of a commercial deal. Looking at the framework of these transactions, the complexity hits you immediately. We aren't just dealing with a buyer handing a check to a seller.
Not even close.
We're dealing with nested corporate entities, properties that already have dozens of distinct businesses operating inside them, overlapping land surveys, and severe environmental liabilities. To navigate this minefield, the entire structure relies heavily on conditional clauses.
They're the absolute backbone of the contract.
But I want to understand the actual mechanics of these clauses. In the framework we're analyzing, everything seems to hinge on two very specific legal concepts: the condition precedent and the condition subsequent.
Right.
How exactly do these dictate when a buyer is actually locked in?
The best way to understand them is to realize that trust is entirely removed from the equation in commercial real estate.
Zero trust.
Zero. The system is designed under the assumption that everyone will legally exploit a loophole if given the chance. These conditional clauses are the armor. So a condition precedent is essentially your active shield. Think of it like a locked door standing between the buyer and the final binding contract.
Okay, a locked door.
Right. You, as the buyer, have to actively insert the key and unlock that door. The agreement explicitly does not become binding unless one party provides a formal written notice within a rigid time frame stating that the conditions say securing satisfactory financing has been fulfilled.
And if they don't?
If you simply do nothing, if you don't send that written notice by the exact deadline, the deal just dies. It vaporizes.
Okay, so it requires an affirmative action to proceed. You have to actively choose to step forward into the binding contract.
Precisely. Now, contrast, the agreement is binding right from the very moment of acceptance. However, that door will automatically slam shut, meaning a party can terminate the binding agreement if a specific anticipated event falls through within a specified time.
So it creates an immediate binding relationship, but leaves a very specific, narrowly defined escape hatch open.
Exactly. It's an escape hatch.
That makes sense, but let's push that locked door analogy a bit further for the condition precedent. It's not just a locked door. Looking at the sheer amount of capital at risk, it's a locked door with a ticking time bomb attached to it.
Oh, without a doubt.
Because if you don't turn that key by exactly 5:00 p.m. on Tuesday, the entire multi-million-dollar asset disappears from the market and the seller just moves on to the next bidder.
And that ticking time bomb aspect is exactly why this legal distinction matters so deeply. These properties represent massive capital deployments. A condition precedent protects the buyer from being prematurely locked into a disaster while they're still investigating the structural integrity or the rent rolls of the building.
It buys them safe time.
It forces an active, conscious decision to proceed only after the risk has been quantified. And because of this overwhelming complexity, the salesperson handling the transaction fundamentally shifts roles. They aren't just a property tour guide pointing out nice crown molding.
They essentially have to become a project manager.
They absolutely do.
That shift to a project manager role is a critical point. The framework makes it explicitly clear that real estate salespersons are absolutely not expected to conduct the due diligence themselves.
No, in fact, doing so would be a massive liability.
Right. They have to rely on third-party professionals, engineers, forensic accountants, corporate lawyers, building inspectors, environmental scientists. But here is the specific mechanical rule that caught my eye.
The rule of three.
Yes. The salesperson is obligated to recommend the names of at least 3 different third-party professionals in each of those fields to the buyer. I understand the need for experts, but why exactly 3?
It comes down to insulating the transaction from conflicts of interest and protecting the buyer's agency. Well, if a salesperson only recommends one environmental engineer, and that engineer happens to miss a massive toxic plume under the parking lot, the salesperson is legally exposed.
Because the buyer will say you forced them to use that specific guy?
Exactly. The buyer's lawyer will immediately argue that the salesperson steered them toward an incompetent or perhaps overly friendly inspector just to ensure the deal closed and a commission was paid.
That is a dangerous position to be in.
Very. So by providing 3 distinct, reputable options, you empower the buyer to make their own independent selection. The salesperson is essentially saying, here is a curated list of qualified experts. You interview them, you hire them, and you maintain direct privilege with them.
It completely cleanly severs the liability.
It has to. The sheer technical knowledge required to evaluate tenanted commercial property goes far beyond the scope of a standard real estate license. I mean, the buyer needs a forensic accountant just to parse the existing lease agreements and verify the operating costs.
Which perfectly transitions us right into the heart of the investigative phase due diligence.
Here we go.
This is where the magnifying glasses come out and the transaction slows down to a crawl. And what's fascinating is that this phase starts before anyone even looks at a building inspection or a profit and loss statement.
Right. It starts with the people.
Exactly. It starts with simply proving who is actually buying and selling the property. We're talking about FINTRAC compliance. For an audience that follows high-level financial tracking, you already know FINTRAC creates massive logistical bottlenecks.
To put it mildly.
But in commercial real estate, this isn't just taking a photocopy of a driver's license. If the buyer or seller is a corporation, the due diligence requires a full corporate search, and you have to identify the individual authorized signatories.
And that corporate search isn't just a formality. You are often dealing with a numbered company, which is owned by a holding company, which might be owned by a family trust.
It's like a Russian nesting doll of legal entities.
It really is. You have to pierce through all those corporate veils to identify the actual human beings who have the legal authority to move the capital. And if you are dealing with a partnership, the logistical burden multiplies.
Because you need everyone.
Yes, the identity of every single partner is required. There is one notable exception to that rule, however.
What's that?
If it is a formally registered limited partnership, then only the general partner, the one actually managing the liability, needs to sign the agreement and be fully identified.
Okay, that saves some time.
A little. But if it's a standard partnership, You might be tracking down signatures and verified IDs for 15 different people spread across the country.
Just to get the opening paperwork done. And if it's a sole proprietorship, you have to identify the specific individual who actually owns the business, not just the doing business as name on the storefront.
Right. You can't just sign a multi-million-dollar contract with Dave's Bakery. You need Dave.
If you don't legally know exactly who you are dealing with, the entire contract is built on sand. But the strictness doesn't start with corporate identities. It applies to the very concept of time itself within the contract.
Oh, the irrevocable timeframes.
Yes, let's talk about irrevocability. This is the window during which an offer or a counteroffer remains valid and cannot be pulled back. If this time period expires, the offer is dead. But the commercial framework uniquely restricts this.
It does.
The irrevocable time usually must expire during normal business hours, and crucially, it must occur on a weekday. You will almost never see a commercial offer expire on a Friday at 9:00 p.m. or on a Sunday afternoon.
I'd argue it's even more rigid than just a custom. It's a survival mechanism for the professionals involved.
Survival mechanism.
Think about the ecosystem required to execute a commercial counteroffer. This isn't a residential deal where a couple can hash out a $5,000 difference over Sunday brunch. If you receive a complex counteroffer on a $40 million office plaza, you need immediate access to your corporate lawyer to review the indemnity clauses. You need your accountant to verify a complex tax implication regarding the capital gains, and you might need to call your commercial lender to adjust the financing ratios.
And none of those people are working at noon on a Sunday.
Exactly.
Okay.
If an offer expires on a Sunday at noon, none of those professionals are at their desks. Setting the expiry during core business hours, say 5:00 p.m. on a Tuesday, ensures that all parties have full access to their advisory teams before making a legally binding multi-million-dollar decision.
I can just imagine the sheer, unadulterated panic of an agent sitting in gridlock traffic at 4:45 p.m. on a Tuesday, knowing their multi-million-dollar irrevocable window slams shut at 5:00 p.m.
And they desperately need to get a wet signature on a counteroffer. The pressure is immense.
And speaking of immense, we have to look at how the capital actually moves during this phase, starting with the deposits. Because the purchase prices are so massive, the deposit amounts are correspondingly huge.
Oh, absolutely.
We aren't talking about a $5,000 good faith check. These deposits can easily be in the hundreds of thousands or millions of dollars, and they are often given in staggered stages as the transaction successfully passes through various due diligence milestones.
And sophisticated buyers aren't just going to let a $2 million deposit sit idle in a standard brokerage account for a 90-day closing period.
No, of course not. That capital has an opportunity cost.
Exactly. Buyers will mandate that their deposit be placed in an interest-bearing trust account. And this isn't a simple handshake agreement.
It never is.
The lawyers have to painstakingly draft clauses dictating exactly which financial institution holds the trust, what the required interest rate yield is, who pays the administrative fees for managing the trust, and precisely who gets to keep the accrued interest if the deal ultimately falls through.
The management of that capital during the closing period is a high-stakes negotiation in itself.
It really is.
So the corporate identities are verified, the massive deposits are earning interest in a trust, and the irrevocability windows are strictly managed. Now we actually get to the physical property. And there is a legal distinction here that sounds incredibly mundane, but I know it is the source of absolutely vicious legal disputes.
Chattels versus fixtures.
Chattels versus fixtures. To a layman, a desk is a desk, a shelf is a shelf. How does commercial law actually draw the line between what stays and what goes?
The legal test fundamentally comes down to the degree and purpose of annexation.
Annexation meaning how it's attached.
Yes, how permanently the item is attached to the real property. Chattels are movable items owned by the seller. They're not permanently affixed, and they are legally expected to be removed on closing. We're talking about things like freestanding product displays, standard office chairs, rolling garment racks, or lobby furniture.
Things you can just pick up and walk out with.
Right. Fixtures, on the other hand, are permanently attached and are legally considered part of the real property. They stay. This includes built-in cabinetry, hardwired industry-specific manufacturing equipment, or custom architectural lighting.
Okay, that seems straightforward enough.
It seems that way, but the gray area in commercial real estate is vast. What about a massive, custom-built modular workstation system that is bolted to the floor for stability, but can technically be unbolted? Is it a chattel or a fixture?
Oh, I want to build a scenario around this because the liability is staggering.
Go for it.
Imagine a tech company buying a $50 million office space specifically because it has state-of-the-art, custom-built server racks and integrated modular workstations perfectly designed for an engineering team.
A very common scenario.
The buyer's agent assumes these are fixtures because they're heavily integrated into the space, so they don't explicitly list them in the contract. Closing day arrives, the buyer unlocks the door, and the place has been entirely stripped to the concrete.
Completely empty.
Completely. The seller unbolted everything and took it, claiming they were legally just heavy chattels. The buyer is suddenly facing millions of dollars in unexpected infrastructure replacement costs, entirely because the contract wasn't meticulously specific.
And in that scenario, the buyer is immediately suing their own agent and their lawyer for professional negligence.
Rightfully so.
The baseline rule for the commercial practitioners is explicit. Never sue. If there is even a fraction of a doubt about a piece of commercial-grade equipment, you must painstakingly itemize it in the agreement. You have to clearly define exactly what is a chattel being excluded and what is a fixture being included.
Okay, so you meticulously list every single server, rack, and custom desk. We've secured the physical items. But none of that matters if the local government shuts your business down on day one.
Oh, zone.
Which brings us to the ultimate municipal landmine, zoning and present use. Looking at the contracts, there is a standard detail called present use. This simply describes how the seller is currently operating the property today. If it's operating as a commercial bakery, the contract says the present use is a bakery.
But here's the massive trap buyers fall into. Just because it's being used as a bakery today does not mean it is legally zoned to be one.
Wait, really?
Oh, it happens all the time. This is one of those catastrophic risks a buyer can face. Present use is merely a statement of current physical reality. It is absolutely not a warranty of legal compliance.
So they could just be operating illegally.
Exactly. You could have a building that has been operating as a heavy manufacturing facility for 15 years. The buyer purchases it, assuming they can continue manufacturing. But during the permit transfer process post-closing, the municipality flags it.
Let me guess, it's not zoned for it.
It turns out the property was only ever zoned for light industrial storage, and the previous owner was operating completely illegally under the radar for a decade and a half. The municipality issues a cease and desist. The new buyer now owns a massive facility that they legally cannot use for their core business. The income stream evaporates overnight.
That is genuinely terrifying. It highlights why you cannot take a single thing at face value. You have to verify the municipal bylaws directly. And this exhaustive need for verification requires a specific set of tools. Let's open up the commercial real estate toolkit and look at the commonly used clauses that make up the due diligence phase.
The first major one is the legal and financial conditional clause.
Right. What does that actually entail?
This clause is the heavy lifting of the entire transaction. It provides a highly structured window of time strictly for the buyer's corporate solicitors and forensic accountants to tear apart the reality of the property.
Tearing it apart legally.
Exactly. The legal analysis involves combing through the property title for hidden easements, reviewing all existing mortgages, analyzing architectural surveys, verifying operating licenses, and explicitly confirming that zoning compliance we just discussed.
And the financial side of that clause is practically a corporate audit.
It is an audit.
The buyer's accountants are reviewing income and expense statements, balance sheets, and rent rolls. And it's not just looking at the top-line revenue, it's digging into the operating costs, the property tax bills, the historical utility costs, and even employee records if unionized maintenance staff are being transferred with the building sale.
You are essentially auditing a complex, living business just to buy the concrete shell it sits in.
Once the paperwork is audited, you have to audit the physical reality. That introduces the building condition clause.
And a commercial building inspection is leagues beyond having someone poke the drywall with a flashlight. It is a massive undertaking.
What are they looking for?
The resulting report will dissect the building envelope, the structural load-bearing design, the heavy mechanical HVAC systems, the commercial-grade electrical grids, and the integrated life safety and sprinkler systems. The core objective here is to uncover material defects and, most importantly, deferred maintenance.
Deferred maintenance. This is such a polite, bureaucratic way of saying the previous owner was cheap, ignored the failing roof for 10 years, and now it's going to cost you $2 million to fix it.
That's the exact translation.
But even if the building is structurally pristine, we have to look beneath the foundation. This brings us to the environmental conditional clause. This provides a specified time for the buyer to assess the environmental integrity of the soil and groundwater. And the standard here is the Environmental Site Assessment, or the ESA. Why is this environmental scrutiny so intensely specific to commercial transactions?
Because the historical use of commercial land can harbor invisible, financially apocalyptic liability.
Financially apocalyptic.
Truly. Let me give you a very common, very dangerous scenario. You're looking at a beautiful, modern boutique clothing store in a gentrified downtown corridor. It looks perfect.
Right.
But an ESA Phase 1 investigation digs into the historical municipal records and discovers that in 1985, that exact lot was a dry cleaner. And in the 1980s, dry cleaners used a chemical called PERC, perchloroethylene. It is a highly toxic solvent. If those old tanks leaked into the soil, you don't just have a contaminated lot, you might have a toxic plume migrating through the groundwater into the neighboring residential properties.
And if you buy that property without discovering it,
You own the liability. Environmental liability in commercial real estate often runs with the land.
so the government doesn't care that you didn't spill the chemicals in 1985.
They do not care at all. You are the current owner on title. You are legally responsible for the multi-million-dollar remediation and the lawsuits from the neighbors. This is why the environmental condition precedent is an absolutely non-negotiable shield in commercial agreements.
Wow. From the invisible toxins in the soil, let's move to the highly visible logistical tension of the transaction. There is a clause commonly referred to as showing to future tenants.
That one always causes friction.
Right. This allows the buyer to show the property to prospective new tenants before the closing actually happens, usually requiring 24 hours notice to the seller. Think about the incredible tension here.
It's extremely awkward.
The buyer doesn't officially own the property yet, but they are terrified of vacancy, so they are actively parading new businesses through the hallways to secure leases. Meanwhile, the current seller, who might be a failing business themselves, forced to sell the building, is still occupying and operating the space.
The tension is palpable, and it has to be intensely managed by the contract. The seller doesn't want their current employees or customers to know the building is being sold, yet the buyer is marching architectural planners through the lobby.
Right, trying to measure the floors for their new layout.
Exactly. It requires strict parameters around when and how these showings can occur to prevent the seller from sabotaging the buyer's prospective leases.
And let's say all the documents check out, the soil is clean of 1980 solvents, the building is solid, and the new tenants are lined up. As we approach closing, there is a clause regarding the physical handover of the space if the seller has been doing renovations. The cleaning after renovations clause.
Yes, the broom-swept clause.
It legally mandates that the premises must be left in a clean and broom-swept condition on closing. It sounds almost quaint, but it highlights the necessity of establishing a baseline. You can't just leave a mountain of drywall dust, shattered tiles, and leftover lumber in the middle of a newly renovated office floor.
Broom-swept is the legal definition of minimum acceptable cleanliness. It removes the subjectivity.
And finally, before we leave the toolkit, we must discuss the confidentiality agreement, formalized as OR-RE Form 560.
Crucial piece of paper.
Because the buyer's due diligence requires them to look at the seller's corporate tax returns, proprietary rent rolls, and sensitive employee contracts, this separate standalone agreement is mandatory.
It legally ensures that all proprietary information is kept strictly confidential by the buyer, and all documents are destroyed or returned, even if and especially if the deal ultimately falls through.
Because you cannot allow a competitor to use a fake offer just to conduct corporate espionage on your rent rolls.
Precisely. It happens more than you'd think.
Okay, so we have the anatomy and we've deployed the toolkit. Now, how do we actually execute the deal? Let's talk about the math and the signatures. At the end of the day, someone has to write a very, very large check.
The best part of the deal.
For the seller, certainly. The legal format for the balance due on completion states that the buyer agrees to pay a further sum of blank, subject to adjustments, to the seller, using funds drawn on a lawyer's trust account via a bank draft, certified check, or wire transfer using the large value transfer system.
The LVTS.
First of all, let's clarify that last part. When the paperwork mandates the large value transfer system, we aren't talking about sending an e-transfer from your phone.
Not at all. Standard retail banking clearinghouses literally cannot process a $50 million building purchase smoothly. The fraud triggers and daily limits would freeze the transaction instantly.
It would flag as massive fraud.
Instantly. The Large Value Transfer System, or LVTS, is the heavy-duty interbank wire framework used by the central banking system to instantly and irrevocably settle massive financial transfers between institutions. When a commercial deal closes, the capital moves through this specialized pipeline.
So we know how the money moves, but how do we calculate the exact amount that goes into that LVTS wire? How do we fill in that blank space for the balance due? The industry relies on an acronym, the SAD method.
Well,
Can you break down the actual financial mechanics of SAD?
certainly. It's the core equation for the final financial settlement. You begin with the total agreed-upon purchase price. To find the final balance due, you must subtract S, A, and D.
Okay, let's go letter by letter.
The S stands for seller takeback, the A stands for assumed mortgage, and the D stands for the total of all deposits already paid.
Let's dissect why a transaction would actually use the S and the A. Because they aren't just math, they're complex financing strategies. The seller takeback, this is essentially a loan the seller provides directly to the buyer to help fund the purchase. The seller acts as the bank and takes back a mortgage on their own property. Why would a seller ever take on that risk instead of just demanding cash?
A seller takeback is often used to save a deal when traditional commercial lending tightens up.
Like if interest rates spike.
Exactly. Let's say the buyer's bank will only finance 65% of the purchase price, and the buyer only has 20% in cash. There is a 15% gap.
So the deal is dead.
The deal is dead. But the seller, who really wants to offload the asset, agrees to finance that remaining 15% themselves, usually at a highly favorable interest rate. It bridges the gap and keeps the transaction alive.
That makes perfect sense. Now, what about the A, the assumed mortgage? This is when a buyer chooses to legally assume or take over the seller's exact existing mortgage rather than getting a brand new loan from a bank. In what scenario is a buyer voluntarily taking on someone else's debt structure?
It is entirely about preserving a favorable interest rate.
Which is huge right now.
Massive. Imagine a seller locked in a 10-year commercial mortgage 5 years ago at a fixed rate of 2.5%. Today, current market rates are sitting at 7%. If the buyer gets a new loan, their debt servicing costs will be astronomical.
It changes the whole profitability of the building.
Completely. But if the commercial mortgage contains an assumption clause, the buyer can legally take over that existing mortgage and inherit that beautiful 2.5% rate for the remaining 5 years. It dramatically increases the profitability of the asset.
So you take the purchase price, subtract the seller takeback, subtract the assumed mortgage debt, subtract the deposits already sitting in trust, and whatever number is left is the final check wired through the LVTS.
It's an elegant mathematical formula for a highly complex financial maneuver.
But once the math is finalized, the physical execution of the document is governed by incredibly strict rules regarding initials and signatures. Every single page of the offer, every amendment, every schedule must be initialed in the appropriate space by all parties, except for the final signature page.
And you can't miss a single one.
And when we get to the signatures themselves, the rules change drastically depending on the legal entity. For corporations, the authorized officers must add the word per before their signature. But here is the part that I find fascinating from a legal defense standpoint.
The corporate seal.
Yes, they must use an official corporate seal, or they must physically write the incantation, we have the authority to bind the corporation. Why is that specific phrase so critical?
I completely agree. It feels like a legal incantation, but it serves a vital protective purpose. You have to remember that a corporation is a distinct, standalone legal entity, entirely separate from its employees or even its managers.
It's its own person, legally.
Exactly. You cannot have a rogue middle manager arbitrarily deciding to sell off a company's $20 million real estate asset because they feel like it.
Right.
When a signatory physically writes, "I have the authority to bind the corporation," it is a legally binding, actionable declaration. They are legally verifying that they have been officially authorized by the board of directors, usually through a formal corporate resolution, to commit the entire weight of the corporation to this transaction.
And if they don't actually have that authority?
If they are lying, it constitutes massive corporate fraud. It is the ultimate safeguard against unauthorized sales.
It places the full weight of the corporate structure onto the tip of that pen. And to bring it all together, the completion of the agreement also requires meticulous accuracy regarding real property details. The address, the exact legal description derived from the municipal registry, and any indication of easements or right-of-ways must be flawless.
And because the due diligence clauses require the seller To provide vast amounts of documentation for the buyer to assess, the timeframes built into these contracts might be 30, 60, or even 90 days.
Which perfectly circles back to the salesperson's role as a project manager. Over that 90-day period, it is the salesperson's strict professional obligation to provide a roadmap. They must ensure the client truly understands their ongoing obligations regarding confidentiality agreements, municipal checks, and coordinating those vital third-party experts.
They're driving the bus the whole way.
Okay, we've covered the structural foundations of a general commercial deal, but now we need to split the path. Because an office property and a retail property are fundamentally different beasts with entirely different risk profiles. Let's dive into retail therapy, the special municipal and logistical considerations specifically for retail properties.
This is where things get really public.
If you are looking at a retail space, the areas of concern shift dramatically outward. You aren't just looking at the building, you're looking at how the building interacts with the public.
Precisely. An office building is a generally self-contained, controlled environment. Employees arrive, they work, they leave. Retail properties, by their very nature, require constant, chaotic, high-volume interaction with the general public.
And that invites municipal oversight.
Heavily. This introduces a host of municipal variables that can make or break the valuation of the property. The first major area of public interaction is visibility, governed by sign bylaws.
Signs are the lifeblood of retail.
They really are. But the buyer must be acutely aware that municipal sign bylaws impose ruthless restrictions on the location of a sign, its maximum square footage, and its height.
Let's visualize that retail plaza again. Think about the massive, towering pylon signs sitting right against the main road, displaying all the logos of the anchor tenants. If a buyer is purchasing that plaza and bases their financial projections on the visibility provided by that specific pylon sign, they can't just cross their fingers and assume it's legal.
No. What if that sign was built 30 years ago, and current municipal bylaws prohibit signs of that height?
That is exactly the danger of grandfathered structures.
Exactly. If that sign is currently technically illegal but grandfathered in, and a storm knocks it down, the municipality will not allow the new owner to rebuild it to the same height.
Wow, so you just lose your main advertisement.
The visibility of every single business in that plaza plummets, tenant revenue drops, and suddenly your anchor tenants are threatening to break their leases.
Just because of a storm in a bylaw.
Just because of a bylaw. To protect against this, a representation and warranty clause from the seller must be explicitly inserted into the agreement. The seller must legally warrant that the sign conforms to current municipal sign bylaws, or disclose the non-conforming status so the buyer can adjust the purchase price accordingly.
From visibility, we move to accessibility. We have to look closely at zoning and parking. Zoning bylaws regulate lot coverage, setbacks from the property line, and crucially, parking requirements. And in retail, everything revolves around the parking ratio.
The parking ratio is a non-negotiable municipal metric. It refers to the number of legally available parking spaces divided by the gross leasable area of the property. And the required ratio changes drastically depending on the specific use of the retail space.
Let's explore that calculation. Imagine you are buying a retail pad that currently houses a massive, low-traffic furniture store. People browse for 3 hours, buy a couch, and leave. The parking lot is mostly empty. The municipality only requires a low parking ratio for that use.
Right, maybe 2 spaces per 1,000 square feet.
But you, the buyer, want to kick out the furniture store and lease the space to a high-volume, trendy restaurant and a high-intensity gym.
The moment you apply for the change of use permits, the municipality will recalculate your required parking ratio. A restaurant and a gym require massively higher parking volumes than a furniture store.
Because there's a constant churn of people?
Exactly. If your physical lot only has 50 parking spaces, but the new municipal ratio requires 120 spaces for a restaurant, the city simply will not issue the business licenses.
The businesses cannot open.
They cannot open. The salesperson and the buyer's planners must ensure the property's physical footprint can legally support the intensified parking requirements of the intended future use.
And parking spaces are only relevant if the customers can actually get their cars off the street and onto your asphalt. This brings us to a concept called traffic flow, specifically focusing on ingress and egress rights.
Entering and exiting.
Depending on the geometry of the property, the buyer has to ensure that the entry and exit points actually connect directly to the public street.
It sounds absurd to even have to verify that, but it is a massive title risk. You have to check the title or deed for registered ingress and egress rights. There are countless scenarios where a retail plaza's main driveway actually crosses over a sliver of land owned by the neighboring property or owned by the city.
Right. Imagine buying a thriving retail plaza, only to discover during the title search that you don't actually own the 20 feet of asphalt connecting your parking lot to the main highway.
That's a nightmare.
You only had a temporary access agreement with the neighbor, and the neighbor decides they hate the new owner and puts up a chain link fence across the driveway. Your plaza is completely cut off.
And worthless.
Exactly. The legal framework is very clear here. Due diligence clauses must provide that if ingress and egress rights are not explicitly found in the title search, the seller must actively demonstrate legally binding possession of these rights, usually through a permanent registered easement.
It grounds the abstract contract into physical reality very violently.
It really does.
Yeah.
And finally, for retail properties, once the cars are parked and the customers are inside, we must heavily scrutinize the tenant leases. When you buy a tenanted retail plaza, you aren't just buying the bricks and the roof, you are buying the credit risk of the tenants inside.
That's the real asset.
If the buyer intends to assume those existing tenants, the contract requires the seller to provide tenant acknowledgments, formal assignments of tenancy, and explicit legal directions to the tenants to start paying their rent to the new corporate entity. But the real due diligence here is aggressive risk evaluation.
The buyer's forensic accountants need to evaluate the payment histories and pull the commercial credit files of the major tenants.
Why is that so critical for the valuation?
This is fundamental to the valuation of the asset. If you're buying a plaza anchored by a major national grocery store, you might assume the income is guaranteed. But if your due diligence reveals that this specific grocery location has been consistently late on rent for 2 years and has a deteriorating corporate credit file, the value of that entire commercial property is severely compromised.
Because the income stream isn't actually reliable.
The income stream you are purchasing is unstable, and your lender might significantly alter your financing terms based on that tenant risk.
Okay, so we've navigated the anatomy, we've survived the due diligence, we've done the LVTS math, and we've mapped out the specific parking ratios of retail. But as we approach the finish line, we enter the final gauntlet.
The paperwork maze.
Let's talk about the paperwork maze amendments, waivers, and pre-closing landmines. Even after an agreement is fully accepted and binding, the reality of a 90-day commercial closing period means things are going to change. To manage this chaos, the industry relies on a highly rigid set of standard forms. The first is OREA Form 570, the Amendment to Agreement of Purchase and Sale.
An amendment is a surgical tool used by the parties to make legally binding changes to an already accepted agreement. And the rules for drafting an amendment are incredibly strict to prevent ambiguity.
You can't just cross it out and initial it.
You cannot just cross things out with a pen and initial it. The wording being deleted from the original agreement must be typed into the amendment exactly as it appeared in the original. Then, the new wording, which is to be added, is inserted, along with a brand new irrevocable date and time specifically for this amendment.
And what happens if the seller looks at your amendment, say, you want to drop the purchase price by $50,000 because the roof inspection was terrible, and they just say no?
The framework clarifies that if the changes are not accepted, or if a counteroffer is not made within that new irrevocable time, the proposed amendment simply evaporates. It becomes null and void, and the original agreement remains fully effective and binding.
But if they agree, the party making the changes signs it, sends it over, and the other party signs the confirmation of acceptance.
Now, we need to carefully navigate through two closely related but legally distinct forms that agents frequently mix up, often resulting in massive liability: Form 574 and Form 573.
Let's start with Form 574, the Notice of Fulfillment of Conditions.
When completing this form, you must explicitly cross-reference the original agreement and state exactly which condition is being fulfilled. Crucially, this is the form used to notify a party that a condition precedent or a true condition precedent has been successfully satisfied.
Going back to our locked door analogy, sending Form 574 is the act of turning the key and actively unlocking the door. When Form 574 is signed and delivered by the specified deadline, it officially cements the agreement of purchase and sale into a legally binding contract. But what if you look at a condition, say, the requirement to get a building inspection, and you decide, you know what, the building looks fine, I don't want to spend the money on an inspector, I just want to skip this condition entirely. That is where OREA Form 573 comes in. The waiver.
A waiver is typically used by the buyer before the expiry of the conditional date to simply remove one or more conditions from the agreement entirely. Just like the Notice of Fulfillment, The waiver cross-references the original agreement and explicitly lists the conditions being waived.
And just like the notice, signing and delivering this form locks the parties into the legally binding agreement.
However, there is an absolute, non-negotiable legal rule regarding waivers that catches inexperienced agents off guard.
Let's put a massive spotlight on the strict rule. The legal framework explicitly dictates that a waiver cannot be used with a true condition precedent. A standard condition precedent is something under the control of the buyer or seller, like getting financing. A true condition precedent relies entirely on the discretionary action of a third party, usually a government body. The most common example is municipal approval for severing a commercial lot into two distinct parcels.
Exactly. The buyer and seller cannot legally agree to simply waive the municipality's authority to approve a land severance.
You can't just opt out of the government.
You can't. The contract fundamentally cannot exist until the city says yes. If an agent mistakenly uses a waiver form, Form 573, to bypass a true condition precedent regarding severance and the parties proceed to closing, the entire transaction is illegally founded.
The title transfer is void.
The difference between fulfilling a condition with Form 574 and waiving a condition with Form 573 is a major area of professional liability. Furthermore, to complete the picture, a waiver is never required for a condition subsequent.
Because as we established earlier, that door is already open and binding. You don't need to waive a condition to keep a door open that is already open.
Exactly right.
But even if all conditions are fulfilled perfectly, the correct forms are faxed at 4:55 p.m. and the LVTS wire is prepped, the transaction is still not safe. This brings us to pre-closing issues, the 11th hour landmines that are often entirely beyond the control of the buyer, the seller, or their agents.
This is where the real legal drama happens.
First up, financing difficulties. Because commercial transactions take so long to close, the macroeconomic environment or the buyer's internal financial situation might radically shift. A buyer who was perfectly qualified by their commercial lender 90 days ago might suddenly become unqualified if the lender changes their stress test criteria and the multi-million-dollar financing simply vanishes 3 days before closing.
And if the financing vanishes after the conditions have been fulfilled, the buyer is in breach of contract. They stand to lose their massive deposit and will likely be sued for the difference in property value.
Another significant, highly complex landmine is innocent misrepresentation. This occurs when a statement of fact made by one party to the other is believed honestly and genuinely at the time, but turns out to be entirely false at a later date.
It's a very tricky legal area.
I want to spend a minute on this because the fallout is incredible. Imagine a seller is walking the buyer through a high-rise office building. The seller honestly believes and explicitly states that the massive multi-million-dollar rooftop HVAC system was completely replaced 5 years ago.
They aren't lying.
They aren't lying. They genuinely believe it based on what their property manager told them years ago. But during final pre-closing mechanical checks, the buyer's engineers pull the serial numbers and discover the replacement actually happened 12 years ago. The system is nearing the end of its life cycle.
In this scenario, there's absolutely no malicious intent. There was no corporate fraud. It was an honest memory lapse. However, the legal reality is that the fundamental facts of the asset being purchased have materially changed.
So what happens?
That innocent misrepresentation gives the buyer powerful legal leverage. Depending on the severity, it may result in the buyer legally refusing to close the transaction because they agreed to buy a building with a new HVAC system, not an obsolete one. Or it forces an immediate, aggressive renegotiation of the purchase price on the eve of closing.
Imagine a $50 million deal blowing up over an honest memory lapse about an air conditioning unit.
It happens.
Then we have title problems. A final title search conducted by the lawyers right before closing might reveal highly unfavorable, newly registered results. We are talking about a sudden construction lien placed on the property by a paving contractor who wasn't paid for fixing the parking lot last month.
Or a massive legal judgment registered against the seller's corporate entity that freezes their assets.
Or a completely undiscovered historical right-of-way that poses massive logistical problems for the buyer's intended redevelopment of the land.
The title must be clear of encumbrances to transfer, so these surprises force the lawyers into an absolute frenzy to clear the liens before the closing window shuts.
And finally, there is the most visceral pre-closing issue, a physical change in property condition. The property may suffer significant physical damage between the time the agreement was signed and the closing date.
A heavy storm could rip the roof off.
A pipe could burst on the fourth floor, flooding the newly renovated lobby down to the concrete. Or, returning to our earlier discussion about the chattels and fixtures, you show up for the final pre-closing walkthrough and find that someone broke in over the weekend and stripped all the copper wiring out of the walls.
Or the seller completely misunderstood the contract and mistakenly unbolted and took all those custom built-in trade fixtures we talked about.
The framework is very clear on this. In these cases, the seller must be immediately notified to handle the deficiencies and repair the damage, or the agreement itself must be urgently amended to adjust the final LVTS wire purchase price based on the exact forensic cost of repairs or replacements.
Dealing with these pre-closing landmines really connects directly back to what the industry defines as leading practices for commercial salespersons. A competent salesperson doesn't just write a contract and wait for a commission check.
Right.
They rely on aggressive research skills, deep financial literacy, and robust, obsessive documentation capabilities. The most important safeguard against these closing problems starts with ensuring the absolute accuracy of documents in a timely manner.
And sometimes the simplest tool is the most effective: maintaining a master checklist. A checklist helps track the transaction's progress because these commercial agreements contain dozens of interconnected conditions, all with different rigid business hour timeframes for fulfillment.
The salesperson is also obligated to relentlessly provide all pertinent documents, updates, and municipal responses to the buyer's lawyer for assessment. And they must provide up-to-date information. Over a 90-day closing, the reality of the property changes.
Absolutely. The final piece of leading practice advice is regarding financing and insurance. The salesperson must continually verify that the buyer's interim financing remains fully available and committed during the entire length of the transaction. And crucially, they must verify that the insurance coverage on the property continues right up until the exact, literal minute of closing.
If a building burns to the ground an hour before the title officially transfers, and the seller let the insurance lapse yesterday, thinking the deal was done,
the legal and financial fallout is truly unimaginable.
it would be a total catastrophe.
So what does this all mean for you? Let's zoom out and look at the macro picture. We've just navigated an incredible interlocking system of mechanical complexity. We've seen how standard, rigid OREA forms, rigorous environmental soil due diligence, municipal parking ratio calculations, and incredibly precise legal language from the SAD mathematical method to exact corporate board signatures all have to perfectly, flawlessly lock together.
It's a machine.
The entire ecosystem is meticulously designed to relentlessly protect the buyer, the seller, the lenders, and the operational businesses involved from catastrophic financial risk. And it's operating under the baseline assumption that no one can be trusted and everything must be verified.
I think the most important takeaway from dissecting this framework is a permanent shift in perspective.
How so?
Well, the next time you walk into that local independent coffee shop in your favorite retail plaza, or you step into the high-speed elevator of your downtown office building, I want you to look around differently. Don't just look at the architecture or the polished granite or the interior design. I want you to visualize the invisible.
The paperwork.
Picture the towering, load-bearing stack of legal clauses, the years of historical environmental site assessments, the true condition precedent waivers, the intensely debated chattel lists, and the exact municipal parking ratio calculations that all had to be flawlessly executed, faxed by 5:00 p.m., and wired through the large value transfer system just so you could stand in that exact spot holding a cup of coffee. The physical building you're looking at is just the fragile outer shell. The real indestructible foundation of that structure is the paperwork.
And with that invisible mountain of paperwork firmly in mind, we've reached the end of our journey today. Thanks for joining us on this deep dive into the hidden, high-stakes machinery of commercial real estate. Until next time, keep looking deeper.